What is the future of Indian stock market? What is the expected return of stock market in the next 10 years? Against this uncertain global backdrop, India has increasingly been in the spotlight among the fastest growing major economies. India is in a stronger position than it was earlier. As a country, we are fortunate to see more tailwinds and very few headwinds. In this video, let us understand the future of Indian stock market and predict the Sensex and Nifty 10 years from now. Welcome to holisticinvestment.in. As of September 2023, Sensex is at 67,000 levels and Nifty is at 20,000 levels. 10 years ago, in September 2013, the Sensex was at 20,000 levels and the Nifty was at 6,000 levels. If someone have invested rupees 1 lakh in September 2013 in Sensex, the present value would be 3.29 lakhs. In Nifty, it could have become 3.25 lakhs. To understand the future of Indian stock market and to predict the Sensex and Nifty 10 years from now, let us look at what is working in India's favor right now. First, food and vaccine security. We have food security, vaccine security. Since India is a domestic consumption based economy, the economy is less dependent on the global economy. We are not over dependent on exports. We have such a large domestic market that whatever is produced is consumed here. Next, import of crude oil at lower prices. We have demonstrated the ability to negotiate the import of crude at lower international prices, which has worked well for our foreign exchange purposes. Since the Russia-Ukraine war, India has emerged as one of the world's leading consumer of cheap Russian crude oil. Next, steady increase in tax collection. There has been a steady increase in tax collections owing to better compliance by people. In fact, tax collection last year grew by 18%, which was higher than even the budget estimates. I am talking about direct tax and GST. Next, high frequency indicators are solid. Almost all high frequency indicators are performing well, including a smart recovery by sectors that have been impacted by COVID-19, such as tourism and hospitality, among others. Probably tourism and hospitality are doing much better now than they ever did. Next, strong digital public infrastructure. Aadhaar, UPI and account aggregators are just a few of the DPI initiatives that India has successfully adopted. Due to these initiatives, financial and social inclusion has been possible in a variety of industries, revolutionizing the digital world. We are reaping the benefits of strong public digital infrastructure, which much of the world now wants to emulate. Next, financial system in strong position. The Indian banking and financial system, which had its trouble in the earlier days, is now in a much stronger position. All banks are well capitalized. The non-performing loans have come down sharply and the system is strongly regulated. Next, government making efforts to boost manufacturing. We have a government that is pulling its weight to position the country as a global manufacturing hub. And we also have a government that has aligned itself with the goals of decarbonizing the Indian economy in an orderly manner. These are just a few of many reasons why India is looking good and why India is looking attractive to the world. India's story continues to be an attractive one for the long haul, isn't it? Next, we are moving into prediction. Indian stock market in the next 10 years. Having discussed the outlook for the next 10 years, let us do a projection and prediction for the next 10 years on the Indian stock market. What will be Sensex in 2030 or 2033? What will be Nifty in 2030 or 2033? What is the long-term expected return from the Indian stock market? Let us answer this question under three scenarios. Scenario 1. If the market is delivering similar returns as of the last 10 years, at 12.67% per annum, the Sensex is expected to touch 2,20,000 levels. At 12.52% per annum, the Nifty is expected to touch 64,700 levels. Scenario 2. If you think the market will not deliver 12% per annum returns in the next 10 years, we can assume a more conservative return. We can assume 3% less than that of last 10 years. If the market is delivering a conservative return compared to the last 10 years, at 9.67% per annum, the Sensex is expected to touch 1,68,000 levels. At 9.52% per annum, the Nifty is expected to touch 49,400 levels. Under scenario 3, if you think the market will deliver more than 12% per annum returns in the next 10 years, we can assume a more aggressive return. We can assume 3% more than that of the last 10 years. If the market is delivering an aggressive return compared to the last 10 years, 15.67% per annum, the Sensex is expected to touch 286,000 levels. At 15.52% per annum, the Nifty is expected to touch 84,200 levels. We would like to conclude that overall you will be able to beat inflation by investing in the Indian equity market for the next 10 years. India is in the best possible position to attract investors over the next 10 years because of its compelling development story, solid economic base, stable government, and ongoing structural changes. The nation's technology breakthroughs, investment potential in the banking and financial sector, renewable energy, electrical vehicle, present a good chance to produce alpha returns. Indian markets are made even more alluring by inexpensive values of steady growth. But please don't get into investment by just searching through social media platforms. A professional financial planner will guide you better. Stay safe, happy investing. A detailed blog post on this topic is available in our website, and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.